Ladies and gentlemen, while Indian equities have delivered exceptional returns over the past decade, investors today are increasingly asking a critical question. Is it time to look beyond India? In a world that's more connected than ever, opportunities to build wealth aren't confined to national borders. Investing globally allows us to access businesses that operate at scale, dominate global platforms, and benefit from broader structural trends. Trends that may not be fully captured within the Indian market. Our next session titled Why and How to Diversify Beyond Indian Equities explores the strategic and practical aspects of global diversification and how it can enhance long-term portfolio resilience and returns. We are pleased to have with us once again Mr. Bhavin Shah, founder and CIO of Sameeksha Capital, a name that stands for performance with principle in the world of investing. In this session, Mr. Shah will share his unique perspective on identifying market leading global businesses with durable competitive advantages. Companies that are not just surviving through cycles, but compounding capital consistently across geographies. His investment approach is sector and geography agnostic, focused on businesses that either shape the future or have moats that are nearly impossible to replicate. Whether it's tapping into companies with global platforms, reducing geographical concentration risk, or understanding the dynamics of developed and emerging markets, this session will equip you with a broader lens to think beyond borders. And on that note, let's once again welcome Mr. Bhavin Shah.
Focus on those two markets, although technology was another overlay and which brought companies from other countries as well. Um, when I first wrote a research report on a Indian company, it was on Infosys with the title, "This is just the beginning." And the market cap at that time was $100 million. Obviously, we know what happened after that. So I personally have invested in both the global markets, primarily through US, but also some non-US companies. And also, obviously, over last 15 years or so, I have focused on India as well. And, the same thing is what we offer at Sameeksha. So let me just walk you through. I think I talked about our firm, so I won't repeat that. So this is the data on markets starting in, obviously starting points always are kind of, they can skew the outcome. So, but anyway, with that caveat, this, data set starts in 2000. And obviously there was a dot-com bubble and crash. And that's why if you take last 25 years, Indian market has done far better than any other market. But for other periods, US market actually comes pretty close. Especially if you look at the periods over last 20 years, and in particular Nasdaq, or if you take last 10 years. So the study that we did in '96 and the results in the subsequent 30 years kind of confirm that those are the two markets. So that was the purpose of mentioning that study. If you take, I always believe that don't look at point-to-point returns, look for rolling period data, because depending on what your start point is and what your end point is, you will end up getting very different results. So when you look at the rolling period results, and we have cut this in a few different ways, average or median, and you look at 5 years, 10 years, 15, 20 years, the US market has delivered pretty healthy returns, whether you look at S&P 500 or Nasdaq. Obviously, Nasdaq returns have been very strong because of what's happened in the technology sector. The other important point is, in my previous presentation also, I talked about returns and risk. So here also, I bring in the risk element. So these are the three. One is S&P 500, then it's Nasdaq, and there is Indian market. Um, what you notice is that the volatility, the standard deviation for the US market is significantly lower than the Indian market. So, that is the other aspect of thinking about the investing out, in the markets apart from investing in Indian market. I think when anybody who studies investments, in a investment theory, that is, the first thing they teach you is that you broaden your universe. Your returns may or may not go up, but your risk, generally speaking, reduces. And to make that point in a more simple way, if you let's say you decided that you will only invest in a companies based in Karnataka versus companies based in India, clearly, you're going to do better if you choose India rather than just Karnataka. So same concept, applies on a much grander scale when we talk about global investing. Obviously, US market has very strong regulation, very strong compliance. You know, one of the important differences, if you ask me, like, what is the difference between investing in Indian company and US company? And, my analyst who works in this global companies is also here, Rachit. When I gave him the checklist that we follow for Indian companies, there are 30 items for corporate governance. He was saying, why are you wasting my time? Those companies don't have this kind of corporate. So in Indian company, we are always trying to, you know, basically make sure we don't bump into any minefield of corporate governance. In a US context, those risks are far lower. Just a little bit about our track record. So we have been offering a PMS-like service, far simpler than Indian PMS. One-step account opening and very easy to monitor for more than 6 years. And these are clients across time, with different duration, and we have seen varying degree of outperformance for all these clients. And also, bringing in the risk element, the Sharp ratio has been higher across board for clients versus the benchmark. And this is a comparison of various periods for the aggregated portfolio of all the clients, versus the S&P 500 as well as versus BSE 500. There is meaningful outperformance. So there's clearly a value in doing what we are doing. We believe. I think again the same thing. I think just this is graphical representation, so I'll skip that. Now, where we are in where is the market, US market today? There was a big correction earlier in the year. Then came the pause. One fine day, Mr. Trump announced a pause, and the market started to rally, and has been rallying till 2 days ago or yesterday. Obviously, now with the reality of tariffs kicking in, markets have seen a small correction, just 1 day, but there could be more. But what I want to point out is the valuations. You're seeing a lot of red here. Whether it's the P multiples or price to book, or the Sameeksha ratio I talked about earlier in the session, market cap to GDP, which Warren Buffett uses, bear bond earnings yield ratio. On almost any measure, US market does look fairly extended. Ionic, the interesting thing is, even with this, if you compare stock by stock, a US company and Indian company, you will find that US stocks are still more cheap, more reasonably valued than Indian companies. So, just for the sake of. I think I'll talk about a couple of investment examples. I'll also invite my analyst Rachit to come and talk about it. Our investment approach is, in the global context, is in many ways similar to what we do in India. We have a partner in US. His name is Ashwar Menon. He is IIT Madras graduate who went to US, followed a similar career as me, and has been a portfolio manager for last 20 plus years. And so he works with us. I also bring in whatever I have the understanding of, and then we do common research, and then we run our own portfolios. So we'll talk about a couple of investment examples. I'll also go through more details of our portfolio, and then maybe leave some more time for questions. So first is TSMC.
Thank you, sir. Good afternoon. So TSMC was one of the stock which was always in our radar. The reason was the strong moat, cash flow generation, and the high margins. We acknowledge that there is a lot of geopolitical risk in this stock, but even after that geopolitical risk, the end customers have increased their dependency on TSMC over the years. We can cross-check that by the fact that TSMC has 90% market share in the advanced technology. Uh, we invested in the stock in July 2022. At that point, we identified that end segments like smartphone and HPC, the high performance computing, were going through a rough patch. We had the experience of Bhavin sir, and we thought that there was strong tailwind in the AI and the data center, because of which we developed the conviction to invest in the stock at that point of time. The conviction for now has proven right, and the stock has given 20% KGAR in the 5 years period for both revenue as well as the PAT. So thank you.
So let me add to what Rachit said. My career started by looking at semiconductor companies in India. So I published a report on TSMC in 1996. At that time, there were multiple players in the industry. So there was still unclear who is going to be, how the industry will look, say 10, 20 years from now. And, what is the role of this industry overall in the semiconductor space. What became very clear by doing, just a simple industry analysis is that the model that the TSMC and other companies follow, the semiconductor foundry or contract manufacturing, was far superior to the previous models where companies would own their own fabs. And as a result, was poised for significant growth, number one. However, there was second and very important element, which was Taiwan. Uh, the talent, engineering talent in Taiwan, along with the Chinese manufacturing discipline, and this is something I talk a lot about with a lot of people, in terms of the Chinese manufacturing discipline, or I think those two things combined. When I did the analysis first time comparing TSMC to say Intel, the cost difference was so high, I thought something is wrong with my analysis. So I did not publish it. I asked many people. Finally, it was true. So, here it was a company that was perhaps 1 to 1.5 generations behind Intel in technology, but significantly lower cost. What happened over subsequent 20 years is that TSMC kept improving its technology bit by bit while carrying along the cost advantage. And as a result, eventually it overtook Intel. And as Rachit said, today they have 90% share of leading edge technology nodes. Interestingly enough, the stock was available at a ridiculously cheap valuation, even in 2022, or even maybe a year back. So for us, it was a no-brainer to invest in this company. I mean, when we invested, it was available at 16 times earnings. Now, if you try to find a company in India with this kind of competitive advantage, global impact at 16 times, I think I can keep looking for it and never find it. So this is the access you get by investing outside India, the kind of companies that are globally important. The second example is of Meta. Again, in the technology space, I guess, but more of, you could say the company is a technology company, but it sort of impacts every person, through its, products. And again, it was available because there were some bits of, issues that are being talked about, competition from TikTok and other big tech rivals affecting its, sort of overall pie. But I think the company had enough going for it, and I think the stock basically had corrected significantly when we invested. And I think one thing that we pay attention to is the cash flow yield. So this was a company available at 13% operating cash flow yield, 5% free cash flow yield. If I find any company in India, with this kind of number, I immediately jump. It's so difficult to find. P multiple of 17x. Um, so I think Meta has done phenomenally well, even through the AI transformation. Launched some very interesting products in VR space, and it has been a great investment for us as a result. This is our portfolio. It's very heavily dominated by tech companies. But there are other companies, there is Roche, I don't know how to pronounce it. There is also Berkshire Hathaway, there is BYD, by the way. It's a Hong Kong listed company. Um, and so, yeah, I think the exposure is high to semiconductor technology and financial services. So I think I can maybe stop here and maybe give more time for questions. Right, that's a very good question. Till now, from last 6.5 years, we have been managing this as a PMS. The way it works is Interactive Brokers is a global online electronic platform on which your account is opened, and we are the manager of the account. You have full access to what's happening in the account, and but we manage the account for you. That is how we have managed this till now. Now there is one challenge, which is to do with US estate tax. Apparently, for a non-US citizen or resident, any account value above $60,000 in a US asset is subject to estate tax. So we have found a solution to this. We are launching a fund in Gift City, in which you can invest as an Indian resident, even through your entity, if you have a non-individual entity, and that fund will then invest in the same strategy. So that option will be there in near future. But historically, it has been a PMS structure. So if you talk about LRS and TCS, the 20%, it is not a tax. It is withholding tax. I mean, it's a, how do I say it? It's something that can be offset against your other tax liabilities. So it is not extra, additional tax. Yeah, yeah. Okay, so yeah, for an individual, it is $250,000 per year per individual. So let's say you have, family, if husband and wife both do it, it's $500,000 a year, and if it's per year, so it's not a per lifetime maximum or anything like that. If you do it through an entity, let's say you have a business entity, then there is another route which is called outbound portfolio investment. Through that route, you can basically invest up to half of your net worth. So that is also a reason why we are setting up the fund, because through that route, you can invest in our fund, but not in the PMS structure that I talked about. Sorry, yeah, I'll come to you. Sorry? Currency. So we don't do anything with currency risk. The money is invested in dollars. I mean, even some stocks may be invested in other currencies. Like say BYD is invested in Hong Kong dollar, or German company may be invested in a euro. So there is that risk in the portfolio, but we don't do anything with that. Dollar overvalued, undervalued. I mean, I don't know. It's still a reserve currency of the world. Yeah.
My question is a little loaded. So we talk about scarcity and abundance. In India today, we have human capital which is in abundance, and our savings from ordinary individuals is very high. So there's a lot of capital that is now available to the financial sector. What role does discipline play in allocating this capital across industries and investments? What is your take on that? If you can share that with us, just to get a philosophical idea of what you think about.
I think, see, a lot of it is left to the free market, so to speak, right? So, for example, there is a lot of IPOs happening right now, a lot of fundraising happening, and markets have been strong, so that they sail through. Sometimes even into businesses that may not be worth funding. But it goes through a cycle. There will be a time when people will have disappointments, and then it will become difficult for people to raise money. So that market has its own cleaning mechanism. There will be periods of fraud and periods of boom and bust. Abundance and scarcity, as you said. That's, I think, just the way it works. And obviously, sometimes governments try to play a role, and they want to sometimes they want to dampen the fraud, or vice versa. But it generally, I think it's best left to the markets to figure out.
But let me ask it in a different way to help you
Sure.
answer and get what I want. Among the investments you made, was something that you felt very good about, that was very dear to you? It may not have been your best stock in terms of returns, but you felt very good investing in a certain company because you felt they did something that you really felt was a very good product, or they did something that you agreed with.
Yeah, so I think some of our stock selection happens that way only. That we actually like the way company is delivering value to customers. I mean, I think Anand Rathi Wealth, as the example we talked about, definitely fits into that criteria. Another company in our portfolio in India, Novama Wealth, is something whose services we use, and we feel that they do a good job of what they do, and that's the reason why we own that stock. I think we have invested in some hospital companies who we think are doing a very I mean, they're being very how should I say, I think without overcharging, they're delivering good service. So I think you feel good about investing in those companies. And there are companies that we would otherwise feel good about investing, but if it doesn't fit our criteria, then we won't invest. So I mean, one thing, since you asked this question, as a philosophy, we don't invest in companies that directly harm living beings that feel pain. So, we don't invest in meat processing companies, for example. and then few other categories like that. I have a difficult time buying a tobacco stove because of that. So it is part of our philosophy, but we don't put it out as our stated strategy because we think it's something that we like to keep it internal. But since you asked the question, I mentioned it. Yeah.
Your first presentation, you told you are using some AI tools. So can you elaborate on that? What kind of AI tools are you using currently?
So, for example, and maybe my teammates can also mention, uh, we have for every company that we have interaction, we take notes and we have a way of categorizing those notes into relevant fields so that, see, if you just take notes, it's an unstructured data. So we want to save it as a structured data. So how do you do that? Well, we have created relevant fields that what did the company say about revenues? What did they say about margin? What did they say about capital intensity? And normally analysts would do it manually, categorization, that takes a lot of time. Uh, we have deployed AI to do the categorization automatically. It is probably giving, say, 80 to 90% accuracy, so it is not 100%, but hopefully over time it will improve. So that's one example. I think analysts are using AI tool to, they would feed in multiple quarters of transcripts and maybe annual reports, and then they start asking questions about what did the company say about this, what did the company say about that. So that's another usage. And there are other things which we are still working on. It's still early stages, but I just gave you examples of where we have already deployed. Yeah. 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 Sure. Yeah, I think we are out of time, so thank you. And actually, both Rachit, Samyak, or me, if you have any other questions offline, happy to answer. Thank you.